a thread I want to pull on the Canadian housing market, because this is a Canadian conference, and you mentioned 55% of income is now going to funding shelter. Recently in your letter, I also believe you called that mortgage interest is up 30% year over year for Canadians, and inside of the next 2 years, 45% of mortgages in Canada are up for renewal, obviously at significantly higher rates than when they were wrote down. This is correct?
This is correct, and the average house price here is still a redonkulous $800,000 or so, $750,000. In the big centers where most of the population lives, like Toronto and Vancouver, the average home price is more like $1 million. Get out a mortgage calculator, please. I do this all the time. Put in the numbers. I couldn't qualify to buy my own house at current rates if I was looking to purchase it right now. The amount of people that can pay the dollars being asked for these assets is just so tiny relative to the bulk of the supply. So this is why I say liquidation event. We talked about it on the stage last year. It's been in the works. It's slow. Real estate cycles take 4 to 6 years or so to bottom. Everybody loses interest and goes, oh, they hiked rates, we're fine. No, we're not fine. It's a lag, and it's coming, and it's evident everywhere you look right now. So I think that's going to continue to be a major theme driving disparity between people and incomes and the economies.
Adam, we were chatting about this lag before we got on stage. So maybe elaborate on what you're focused on and what the public might be misunderstanding in terms of economic response to interest rate changes and the lag that occurs.
Yeah, I'm so glad that Danielle brought this up, because this is exactly my big concern for this year, which is, if you read the headlines, if you listen to, monetary authorities, the administrations, everybody says, look, everything's great, right? Soft landing, no landing. I think people are really beginning to buy that hook, line, and sinker. We saw the stock market take off at the end of last year. People are entering 2024 with a lot of enthusiasm. And they're really acting as if the lag effect is not going to happen this time. I mean, you got to remember that we hiked interest rates more aggressively over the past 2 years than we've ever done in terms of rates and so many rates and heights in such short a period of time. We've also been conducting QT in the middle of that. And I think a big mystery has been, well, then why didn't the recession that everybody expected at the beginning of 2023 materialize, right? I know Danielle has got thoughts on that, and we'll get there. But I think a huge part of that was positive net liquidity that was flowing into the system from a lot of different sources, and it just pushed the timeline out. But it's happened for so long that I think a lot of people have begun to say, oh, it hasn't shown up yet, it's not going to show up yet, right? And so I think that's the big question you got to ask yourself as an investor, and even just as a consumer going into this year, which is the lag effect not going to matter? Is it truly different this time? Or is it going to arrive, and when it does, how pissed is it going to be? And I actually tell Americans to look at the Canadian market, because as you're talking about with housing, you guys are like a preview of coming attractions for us, right? Because you guys have different mortgage duration structure here. You guys have, as you said, 45% of all mortgages here are going to re-rate in the next 2 years?
In Canada.
Yeah, in Canada, yeah. So we get a different structure in the US. It's going to happen there a little bit more slowly. But if rates don't come down in time, what's happening to you guys is going to happen to us. And I do wonder, let's say that Powell is able to deliver the 3 rate cuts that he says the Fed wants to do next year. And the discount rate goes down from what, 5.5-ish to, let's say, 4.5-ish, right? It's still really high relative to what the cost of debt has been for the previous decade, right? And we've got this maturity wall of corporations that's really beginning to arrive now. And we're going to have almost $1 trillion of corporate debt re-rate in 2024. Same thing with consumer households, and we're already seeing the fact that they are taking on debt like crazy right now. We're at record debt levels. A lot of that revolving credit debt is now at record high interest rates. And so, we basically have this date with destiny of, we're going to get to a point of debt saturation where corporations start re-rating and they've got to start cutting costs. Consumers can't keep spending the way they've been. They're really going to start contracting consumer spending. And if corporations react to that by then laying people off, there's a potential for a real downward vicious cycle in consumer spending. U.S. economy is 2/3 consumer spending. That unlocks a lot of pain for us that I think the market is just hugely discounting right now.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, US Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video. So it's logical, and if we had this conversation a year ago and been able to predict what rates we're going to do over the next couple quarters, we would have thought the economy would have been hit by a wrecking ball.
Right.
And all the forecasters predicted this, but it didn't really materialize yet or ever. So Danielle, forecast for 2024, economic forecast, is the wrecking ball coming? Money's more expensive, that makes things harder, right? Or what's your take? Forecast 2024.
So, the U.S. consumer is not going to go down without a fight. In the month of December, American consumers put $55.8 billion on their credit card in a month. $19 billion in buy now, pay later in a month. We've never seen credit growing this fast. The U.S. consumer is refusing to stop spending, and we forget that buy now, pay later is fairly young, but it's not incorporated into credit rating agencies. So they don't see people buying now and paying later. It does not show up.
Buy now, pay later default rates are already spiking, by the way.
It's incredible. But again, there's two sides to every story. And the other side is the regional bank earnings were a bloodbath of charge-offs related to credit cards. So just because you want to take on as much debt as you possibly can, the more these lenders have, Discover Financial is a train wreck, but the more they have to deal with these charge-offs, the tighter lending standards are going to be if Jay Powell holds his ground. The University of Michigan expectations went up in January precisely because we graphed it out for tomorrow's feather, precisely because American households are like, this is awesome, credit conditions are going to loosen up. No, they're not, because the lenders are losing so much money that they're going to make it harder and harder to access that credit. It's demand and supply of credit to U.S. households. And by the way, most post-war recessions that we've gone into with 2 quarters of rising consumption when we're already in recession. That's how hard business investment gets slammed. And every single Tom, Dick, and Harry CEO right now is in a race to do deeper and deeper layoffs. I mean, every one of them are like 25% of our workforce. Big cuts.
Anybody on the panel want to offer a rate prediction for 2024? What do you expect Powell will try to do or be able to do?
I will just say that I don't think they're going to get anywhere near the 5 cuts or 6 cuts that the market has priced in unless he is forced to do so by a market crash. So if there's a credit event, then yes, but I don't think on his own, based on the way things are now, he will cut 5 times or 6 times.
I think that, what I find amazing is people talk about the 25 beeps. I've been around for about 25 years in this business, and they cut by 1 point or 100 basis points if they panic. So we could just have 1 cut of 1%, and I wouldn't be surprised, because they cut in reaction. They're not, they don't do it in advance. They do it in reaction. Going bad, right? So I think that is likely to be the scenario, and the cuts will come a lot quicker than people anticipate when they start.